Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the financial jargon so you don't have to. And wow, has NIQ Global Intelligence PLC given us a lot to decode this time. It looks like they went through quite a roller coaster with their IPO and some major financial maneuvers. So let's dive straight into their latest quarterly report for the period ending the 30th of September 2025. It is a peek into how this global consumer intelligence company is doing after some pretty significant changes, including a big initial public offering or IPO. Looking at the numbers, their revenues for the 3 months ending the 30th of September 2025 went up by over 7% compared to last year. That means they pulled in an extra $70.5 million. This growth was spread across their different regions, with their MEA segment showing a really strong jump. They're saying this is thanks to keeping their clients happy, selling them more services, and even expanding into new markets. Essentially, their core business seems to be chugging along nicely. Specifically, their MEA region covering Europe, the Middle East, and Africa saw revenues climb by a solid $46.5 million. They mentioned that strong renewals of existing contracts and selling new services are key drivers here. It is good to see growth, especially after all the corporate restructuring. Now, you can't grow revenue without spending money, and their cost of doing business, excluding things like depreciation, also went up by about $27.5 million. They're pointing to rising prices and higher employee costs as the main reasons for this increase. It's a common theme we're seeing across many companies right now. One of the biggest jumps we see is in their selling, general, and administrative expenses, up nearly 15%. A big chunk of this is due to a one-time boost in share-based compensation. This happened because of their IPO completion and some bonus stock awards related to that event. It's a significant cost, but often a one-time hit after going public. Despite the revenue growth, the company reported a loss from continuing operations before taxes of $162.7 million for this quarter. This is actually an improvement from the previous year's loss of $197.4 million. So they are moving in the right direction, but it definitely highlights the cost of their operations and recent changes. When all is said and done, their net loss attributable to NIQ was about $198.6 million for the quarter. Again, this is better than the $214.7 million loss from the year before, but it's still a substantial loss. It's clear they are in a growth and investment phase, balancing expansion with profitability. Let's also quickly check the 9-month period. Revenues for the first 9 months of 2025 went up by about $130 million, or over 4% compared to the same period in 2024. The Americas and EMEA segments both contributed to this growth, with EMEA showing particularly strong gains again. For those 9 months, the loss from continuing operations was around $315.6 million. This is still a large number, but it is significantly better than the nearly $635 million loss from the same period last year, showing a clear trend of improvement. Now, NIQ also reports something called Adjusted EBITDA, which is a way to measure their operating performance by stripping out a bunch of one-time or non-core items. For the 3 months ending the 30th of September 2025, their Adjusted EBITDA was $223.7 million, a pretty healthy increase of almost 25% from last year. This tells us that their main business operations are becoming more profitable, and importantly, their Adjusted EBITDA margin improved to over 21%. This is a strong indicator that they are becoming more efficient at turning their revenue into actual operating profit. For the 9-month period, Adjusted EBITDA also saw a significant rise, showing sustained improvement throughout the year. What about free cash flow, which is the cash left over after paying for essential investments like equipment, was negative at $55.1 million for the first 9 months of 2025. This is still a negative number, but it is a big improvement from the $200.8 million negative free cash flow from the previous year. It suggests they are managing their spending and investments more effectively. The company has also been busy acquiring other businesses. They completed the acquisition of Gastrograph AI in April and Mtrix, a company in Brazil, in August. These moves seem aimed at strengthening their technology and expanding their reach, especially in new markets like Latin America. The Mtrix deal alone was about $54.6 million. It sounds like NIQ has also done some major refinancing of their debt. They've significantly adjusted their term loans, reducing interest rates and extending maturity dates, especially around their IPO. This is a smart move to lower their interest expenses, which were a big drain on their finances. For example, their USD term loan has a new interest rate of around 6.8%, They have a substantial amount of debt. As of the 30th of September 2025, their total debt, including finance leases, was over $3.6 billion. While they have refinanced some of this debt, managing such a large amount of debt is always a key focus for investors. Now, a quick note on their internal controls. They've had a persistent issue called a material weakness related to how they handle accounting for acquisitions. This means there is a chance of errors in their financial reporting related to these complex transactions. They've been working on fixing this, but it's not fully resolved yet. This is something to watch as they continue to grow and acquire other companies. NIQ operates globally, so they're exposed to risks from currency fluctuations. They mentioned that a 10% shift in the US dollar against other currencies could impact their revenue by a significant amount, around $305.2 million. They use hedging strategies to try and manage this risk. With all that debt, interest rate risk is also a major concern. They said a 1% increase in interest rates could add over $21 million to their annual interest expenses. They are using financial instruments to try and cushion these impacts. Looking at the overall picture, NIQ Global Intelligence PLC is in a period of significant transformation. They've successfully navigated an IPO, refinanced debt to lower interest costs, and are showing solid revenue growth from their core business. Their move into acquisitions like Trix shows a strategy for expanding their market position and technological capabilities. The improved adjusted EBITDA and adjusted EBITDA margin are very positive signs that their core operations are becoming more profitable, which is exactly what you want to see after such a major event as an IPO. However, the persistent material weakness in their accounting for acquisitions raises a yellow flag. It suggests that their internal systems for handling complex financial events still need improvement. Also, while free cash flow is improving, it is still negative, meaning they are spending more cash than they are bringing in from operations, even with the revenue growth. This is not uncommon for a company investing heavily in growth and acquisitions, but it is something to monitor closely. The large amount of debt also remains a significant factor to consider. In conclusion, NIQ is showing promising signs of recovery and strategic growth, especially with the improved operating margins and revenue trajectory, but they are still working through some financial and control challenges. The market seems to appreciate their direction, but continued execution and strengthening of their internal controls will be key to their long-term success. Alright, that is our breakdown of NIQ's latest filing. What is your take on these numbers and what they signal for the company's future? Are these acquisitions a smart bet, or is the debt load too worrisome? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. And hey, don't forget to check out our Discord community. Linked in the description for more in-depth discussions and to connect with fellow corporate decoders. Thanks for watching. See you next time.